Good day, everyone. You're welcome to this week's Business and Investment Tips Program, a production of RCCG Christ Church Radio with Dr. Ayodeji Ebo, an investment professional. This week, we focus on building long-term stock portfolio, the dividend approach. There was a flurry of seasonal dividend declarations for most quoted companies on the Nigerian exchange last week. Hence, we thought it would be beneficial to discuss how to build a long-term stock portfolio, US and Nigerian stocks, using the dividend approach. Building a long-term stock portfolio with a focus on dividends is a proven investment strategy that generates consistent income, promotes financial stability, and facilitates the gradual accumulation of wealth. This approach appeals to investors seeking passive income, those nearing retirement, and anyone prioritizing steady returns over high-risk growth. Now, what is the dividend approach? The dividend approach involves investing in stocks of companies that pay regular dividends, cash payments distributed to shareholders for a company's profits, rather than focusing solely on stock price appreciations, which is capital gains. This strategy emphasizes selecting companies with a history of paying and increasing dividends over time. The goal is to create a reliable income stream while benefiting from potential long-term growth in stock value. Key principles of the dividend approach. 1. Income generation. Dividends create a reliable cash flow that can be reinvested to enhance future growth or utilized as income. 2. Stability. Investing in dividend-paying companies often leads to greater financial security, as these firms are typically well established and demonstrate predictable earning. 3. Compounding. By reinvesting dividends, you can slightly boost your portfolio's growth potential through the benefits of compounding. 4. Risk mitigation. Dividend stocks typically exhibit less volatility than growth stocks, offering a valuable buffer during periods of market uncertainty. Before you create any dividend portfolio, not every investor is ideally suited for a dividend-focused strategy, especially at the outset of their investment journey. If you are a young investor in your 20s to 40s, not close to retirement and without sizable existing wealth, it may be premature to prioritize passive income through dividends. A dividend portfolio, while stable and income generating, typically does not facilitate rapid wealth accumulation compared to more aggressive growth-oriented strategies. For younger investors, the focus should shift away from immediate passive income and toward a more dynamic investment plan designed to build wealth and meet long-term objectives. At this stage, your primary income, likely from your job, should cover your lifestyle expenses, leaving surplus funds to invest aggressively in assets with higher growth potential, such as growth stocks or diversified equity fund. Once a solid financial foundation is established, transitioning to a dividend approach later, e.g. in your 50s or closer to retirement, can provide the income stability you need. Understanding your life stage and financial priorities is crucial before committing to this strategy. Steps to build a long-term dividend portfolio. 1. Define your goals. Determine your investment horizon, e.g. 10 to 30 years, and decide whether you want to invest dividends for growth or use them as income. You can set a target dividend yield, which is typically 3 to 5% for international stocks and 5 to 10% for Nigerian stock. 2. Identify high-quality dividend stocks using the following characteristics. A. Consistent dividend history. Focus on firms with at least 10 to 20 years of uninterrupted dividend payments and dividend increases. In Nigeria, firms paying dividends for at least 5 to 10 years without a cut, e.g. top banking stocks. B. Sustainable payout ratio. A payout ratio, dividends or earnings, of 60 to 70% or less indicates that the dividend is sustainable. Nigerian banks often maintain 20 to 50% dividend payout. C. Dividend growth. Prioritize companies that raise dividends annually, signaling financial health and confidence. D. Strong fundamentals. Look for low debt, consistent revenue growth, and competitive advantages, e.g. brand strength and market leadership. E. Sector diversification. Spread investments across various industries to reduce risk. In the US, blue chip stocks like Coca-Cola, Johnson & Johnson, utilities such as NextEra Energy and Duke Energy, REITs like Realty Income and Simon Property Group, and financials like JP Morgan Chase and Bank of America. In Nigeria, diversify across resilient sectors like banking, Zenith, GT Bank, UBA, consumer goods, Nestle Nigeria, Dangote Cement. Real estate, SFS, UPDC. Oil and gas, Seplat, Aradel. And telecommunications, MTN Nigeria. 3. Evaluate dividend yield. Dividend yield equals annual dividend per share divided by stock price multiplied by 100. You should aim for a balanced yield, e.g., 3 to 5% for international stocks and 5 to 10% for Nigerian stocks to ensure sustainability. You can compare yields to industry averages to assess relative value. 4. Reinvest dividends. Use a dividend reinvestment plan, DRIP, to buy additional shares with dividend payout automatically. Many Nigerian brokers don't offer formal DRIPs, so you can manually reinvest through periodic purchases. Over time, reinvestment compounds returns, significantly boosting portfolio value. For example, $10,000 invested at 3% yield with 7% annual dividend growth could grow to $76,000 in 30 years, assuming reinvestment. Additionally, a 1 million naira portfolio at 7% yield and 5% annual dividend growth could grow to over 5 million naira in 20 years, assuming reinvestment. 5. Diversify your holdings. Hold between 15 to 30 stocks, international stocks, and 10 to 20 stocks, Nigerian stocks, to minimize company or sector-specific risk. Avoid over-concentration in a single sector or stock, e.g., limit to 5 to 10% of the portfolio in a single company. 6. Monitor and rebalance. Review your portfolio biannually or annually to ensure companies maintain dividend reliability and financial health. Sell stocks that cut dividends or show deteriorating fundamentals, reallocating to stronger options. Adjust allocations if a stock's price surges, skewing into portfolio weight. Stay informed about NGX announcements, CBN policies, and microeconomic trends. Practical example of a dividend portfolio, international stocks. A typical $10,000 portfolio diversified across sectors with an approximately 3.5% average yield. Initial dividend of $350 per year with reinvestment assuming 5% annual dividend growth, with reinvestment assuming 5% annual dividend growth and 3% price appreciation. This portfolio could grow to about $34,095 in 20 years, and if you don't reinvest dividends, your portfolio value will be about $18,061 in 20 years. Practical example of a Nigerian dividend portfolio. A hypothetical 10 million naira portfolio with an approximately 8% average yield diversified across sectors. Initial dividend of 890,000 per year. With reinvestment, assuming 5% dividend growth and an annual average of 3% price appreciation, this could grow to 58 million naira in 20 years. And if you don't reinvest dividends, your portfolio value will be about 18 million naira in 20 years. In conclusion, the dividend approach to building a long-term stock portfolio is a disciplined strategy that focuses on generating income. By selecting high-quality, dividend-paying companies and diversifying across various sectors, you can create a portfolio that generates both cash flow and capital appreciation over time. This method, which emphasizes patience and careful selection, supports financial independence and wealth preservation, making it a key strategy for conservative investment. Thank you for listening. Please join us same time next week for another interesting and insightful session. For questions, comments, and feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 070-8246-3747. Stay blessed.